Owning a clothing store looks like easy money. Find a busy location, stock the latest styles, unlock the doors, and watch the crowd pour in. Then the weekend hits. The store is packed. The checkout line never stops. Shopping bags are flying out every few seconds. From the outside, it looks like a gold mine. And that's exactly where people get fooled. A crowded store can be bleeding cash without anyone noticing. Now imagine a clothing store doing $4.2 million a year in sales. On paper, it looks unstoppable. Then, just 90 days later, the lights are off, the doors are locked, and the business is gone. So where did all the money go? It definitely didn't stay with the owner. The answer is hiding behind every price tag. And that's where this story begins. Here's what almost everyone misses. The owner didn't fail because customers stopped buying. He failed because they never stopped buying. Every sale made the store look stronger, while quietly making the business weaker. That's the trap. More customers didn't create more profit. They created more pressure. The first 10 customers are easy. Everything feels under control. Then the crowds roll in. Employees are sprinting between fitting rooms. Best-selling sizes disappear almost as soon as they hit the racks. The stockroom says one thing. The shelves say another. Returns start flooding back. Tiny mistakes snowball into expensive problems. The store has never looked busier, yet making money has never been harder. Customer number 1 and customer number 1,000 may buy the same shirt, but they cost the business two completely different amounts to serve. Most people think more sales fix a business. In clothing retail, more sales don't hide the cracks, they make every crack impossible to miss. Every clothing store is fighting for expenses customers never see. And the first one starts before the doors even open. Inventory. Unlike a software company that can sell the same digital product over and over, a clothing store has to spend money before it earns any. Every shirt on the rack is cash that's already gone. Now imagine buying $250,000 worth of inventory for the season. If only 70% sells before styles change, the remaining 30% doesn't just sit there. It starts costing you money. Prices get slashed. Clearance racks fill up. Sometimes the inventory becomes worthless. Fashion never slows down just because your cash is tied up. That's why store owners call inventory frozen cash. It looks like profit, but it can't pay your bills. Then comes rent. The best locations attract the most customers, but they also come with the biggest monthly bill. Whether 100 people walk through the door or no one does, the rent still has to be paid. And the costs don't stop there. Every sale triggers another expense. Staff need to be paid. The lights stay on. Payment companies take their cut. Products get stolen, returned, or damaged. New ads have to keep running. Fresh inventory has to keep arriving. Before you realize it, every dollar coming in already has a line of expenses waiting to claim it. The revenue still looks impressive. The profit is disappearing. Then something happens that catches almost every first-time owner off guard. Your best-selling product sells out. Most people think that's a win. For a clothing store, it can be the start of a completely different problem. That's where inventory becomes a constant balancing act. An empty shelf means you're losing sales today, but filling the stockroom with too much inventory can lock up thousands of dollars in products nobody wants tomorrow. Get it wrong either way, and you lose. That's why the best clothing retailers don't just sell fashion. They manage speed. Zara figured this out years ago. Instead of trying to predict exactly what customers would want months in advance, they built one of the fastest supply chains in the world. Stores receive new styles constantly, but in smaller batches. If something flies off the shelves, they make more. If customers ignore it, they move on without filling warehouses with unsold products. That one decision changes everything. Fewer markdowns, less wasted inventory. And because customers know popular items might disappear, they're far more likely to buy on the first visit instead of saying, "I'll come back later." Most independent clothing stores can't copy Zara's supply chain, but they can copy the idea behind it. Inventory that sits still usually loses value with every passing week. And if you think inventory is the biggest risk, the next mistake is even more expensive. Just look at Forever 21. For years, it looked unstoppable. New stores kept opening. Sales kept climbing. Expansion seemed like the obvious answer, until it wasn't. Every new location came with another lease. More employees, more inventory, more fixed costs that never stopped growing. Then customer tastes changed. Online shopping exploded. And all those commitments that once fueled growth suddenly became the weight pulling the entire business down. Then 2019 happened. Forever 21 filed for bankruptcy protection. And it wasn't just because sales slowed down. The business had become become too complicated to keep profitable. That's a mistake far more businesses make than most people realize. Growth doesn't just multiply what's working. It multiplies everything that's not working too. If one store is inefficient, opening 5 doesn't fix the problem. It gives that problem 5 new places to spread. There's actually a name for this. Businesses can reach a point where getting bigger stops helping and starts making everything more expensive. Clothing stores run into this all the time. Another location means another manager, more inventory, more deliveries, more scheduling, more mistakes, more decisions. Before long, the business isn't getting simpler. It's getting heavier. I think of it like an invisible tax, not one you pay to the government, but one you pay every time the business becomes more complicated. Every new product, every new supplier, every new promotion, every new location. Each one adds another moving piece that has to work perfectly every single day. At that point, you're not just selling clothes anymore. You're trying to keep thousands of moving parts from falling apart. And that's not the only number owners misunderstand. Discounts can be just as dangerous. Customers see a 50% OFF sign and think they're getting a great deal. Smart owners look at a different number. What's actually left after the sale? Imagine buying a jacket for $40 wholesale and selling it for $80. On paper, it looks like you just made $40. But once rent, payroll, advertising, payment fees, utilities, and every other operating cost take their share, that $40 can shrink to just $8. That's the number that decides whether the business survives. Now offer a 20% discount. The customer saves $16. Your profit might disappear entirely. That's how quickly the math changes. Discounts bring people through the door, but there's a catch. Run them too often and customers stop buying at full price. They simply wait for the next sale. Before long, your regular price isn't really your price anymore. It's just the number people expect you to discount. That's why the best brands protect one thing above everything else: the ability to charge full price. And this is where many first-time owners quietly lose the business. They're glued to the revenue number while cash is slipping away. Revenue tells you what you sold. Cash tells you whether you'll still be open next month. You can sell thousands of dollars worth of clothing this week and still run out of money because suppliers, landlords, and employees all want to be paid long before those accounting profits become real cash. That's why businesses don't always fail, because customers disappear. Sometimes they fail while customers are still lining up outside. They simply run out of cash first. That's the mistake that takes down more retailers than most people realize. The businesses that keep winning understand this better than anyone. They don't obsess over flashy revenue numbers. They obsess over how fast inventory sells, how much profit each sale keeps, how quickly cash comes back, and how efficiently the entire operation runs. To them, every item hanging on a rack is money waiting to make a decision. Leave it there too long, and the cash is trapped. Discount it too deeply, and the profit disappears. Buy too little, and customers walk away. Buy too much, and the stockroom turns into an expensive storage unit. That's the real business. A clothing store isn't just selling fashion. It's making thousands of capital decisions every single day. By the time customers notice something is wrong, the numbers have usually been broken for months. Empty shelves, clearance signs, liquidation sales. Those aren't where the story starts. They're where it ends. The collapse didn't begin when the doors closed. It began months earlier. The moment growth became more important than efficiency. The moment revenue mattered more than cash flow. The moment looking successful became more important than actually being profitable. Think back to the beginning. The packed store, the long checkout lines, the shopping bags leaving every few seconds. None of that proved the business was making money. It only proved people loved buying the product. Meanwhile, the owner was in the back office refreshing the bank balance, hoping this week's sales would cover next week's bills. That's the part customers never see. The real answer was never on the sales floor. It was hidden in the numbers behind it. Here's something most people never think about. A clothing store can finish its busiest Saturday of the year and still end the day with less usable cash than it started with. More sales can trigger bigger inventory orders, higher processing fees, and more payroll before the money from those sales is fully available. It's one of the strangest realities in retail and one of the easiest to miss. That leads to the lesson almost every successful retailer learns the hard way. Customers see the storefront. Competitors see the crowds. Investors see the revenue. The owner sees the spreadsheet at midnight, wondering why a packed store still feels financially fragile. Better marketing can bring in more customers. Better products can keep them coming back. But neither one fixes bad economics. If every sale leaves less cash behind than you expected, growth only speeds up the problem. And here's the twist. The most dangerous clothing store isn't the empty one. It's the one that's busy enough to hide its weaknesses. Busy stores look healthy. Profitable stores actually survive. There's a big difference. So if you ever think about opening a clothing store or investing in one, don't let the crowds make the decision for you. Follow the numbers. Ask where the cash goes. Understand what each sale actually earns after every cost is paid. Because in retail, success isn't measured by how many shopping bags leave the store. It's measured by how much stronger the business becomes every time one does. If this changed the way you look at retail, you'll enjoy what's coming next, because the same hidden economics explain why many other businesses that look successful from the outside quietly struggle behind the scenes.